Welcome to the Explainer. So every investor, right, you face this exact same problem. You've got all these options in front of you, but how do you actually know which one is the best? I mean, really the best? Well, it's not as simple as it looks. Let's dive in and find out why.
Okay, so let's imagine this scenario. You have to pick between these four options. You've got Fund A, Fund B, Fund C, and just a plain old market index fund. What we're looking at here are their annual returns over a 4-year stretch. And you can already see each one has a totally different story to tell, right?
So your goal is simple. Pick the winner, the one that's going to make your money work the hardest. But how? I mean, what's the right way to measure performance in the first place? Where do you even start? All right, let's talk about the obvious answer and why it's wrong. So let's start with the most intuitive way to do this, the thing pretty much everyone thinks of first. We just look at the average return and, pick the highest number. Easy peasy, right? Okay, first up, Fund A. We run the numbers on its 4-year performance, and it spits out a pretty respectable average return, 5.5%. Not bad, a solid start.
Then we've got Fund B, and whoa, it just blows past Fund A with a seriously impressive 8% average. So right now, you're probably thinking, okay, this is our front runner.
And then there's Fund C, kind of lagging behind the pack here, with an average return of just 2%.
And finally, what about our benchmark, the market itself? It averaged 2.5%. So just looking at this, A and B are crushing it, and C, well, C didn't quite make the cut. So if we're only looking at this one number, the answer seems crystal clear, doesn't it? Fund B, with that awesome 8% return, is the undisputed champ. Case closed. Or is it? Well, not so fast, because here's the massive, gaping hole in that logic. This super simple answer completely, totally ignores the other half of the story. And it's a really important half: risk. All right, the plot thickens. To get a real picture of performance, we absolutely have to bring risk into the equation. Think about it. An 8% return you got from a crazy, stomach-churning roller coaster ride is a totally different beast than a calm, steady 8% return. So how do we actually put a number on that roller coaster ride? Well, in finance, the go-to tool for this is something called standard deviation. The name sounds a little technical, but the idea is super simple. Just think of it as a wildness score for an investment. A high number means a really bumpy journey with lots of ups and downs, so more risk. A low number, that means a much smoother, more predictable ride.
Okay, so let's go back to our funds. But this time, look, we're adding that super important second column for risk. That's our standard deviation. Now the picture is starting to get a little more complete.
And suddenly, things get complicated. I mean, who's the winner now? Fund B still has that amazing 8% return, but just look at its risk number. It's almost 17%. That is way, way more volatile than Fund A. So now, what do you do? Which is better, the high return with a ton of risk, or the lower return with a lot less risk? And this, right here, is the problem. We're completely stuck. We're trying to compare these pairs of numbers, and it's like comparing apples and oranges. There's no obvious way to rank them, so we can't make a clear decision. We're kind of paralyzed.
This is the solution, the Sharpe ratio. This exact problem is what the brilliant economist William F. Sharpe wanted to solve. And he did. He gave us this incredibly elegant tool that just cuts right through all that confusion. It's a way to boil down return and risk into one single powerful number that you can actually compare.
So here it is, the famous Sharpe ratio formula. Now, it might look a little scary at first, but the idea behind it is actually pretty straightforward. Basically, you take the return you got, then you subtract the return you could have gotten from something totally safe, like a government bond. That gives you your extra return. Then you just divide that extra return by the amount of risk you took. That's it. It all boils down to one simple question. How much reward did I get for the risk I took on? So how do you calculate it? It's really just a 3-step process. Step 1, figure out your excess return. That's just a fancy way of saying, how much more did you make compared to a totally risk-free investment? Step 2, you take that extra return and you divide it by the investment's risk score, its standard deviation. And step 3, that's it. The number you get is the Sharpe ratio. It's your risk-adjusted score. And the rule is simple. The higher the number, the better the investment. Okay, this is it. The final ranking, the moment of truth.
Let's take this powerful little formula, apply it to our 4 funds, and finally get a clear ranking that tells the whole story, not just half of it.
And wow, the results are pretty amazing. Check this out. Fund A, the one that seemed kinda decent but not amazing, it's actually our #1 performer. And Fund B, our supposed champion with the highest return, it drops all the way to 2nd place. Why? Simple. That huge return it got just wasn't enough to justify the massive amount of risk you had to take on. The Sharpe ratio tells us the real story.
But that's not even the coolest part. The real power of the Sharpe ratio is that it lets us compare apples and oranges. Its real magic is that it's a universal tool. It gives us one single yardstick we can use to compare completely different kinds of investments.
So let's look at a classic matchup. Which is the better investment? On one side, you've got a stock portfolio. It's got a big, juicy 12% average return, but also a decent amount of risk. On the other side, a super conservative bond portfolio. Its return is way smaller, only 4.2%, but its risk is tiny. Your gut probably tells you to go for the 12%, right?
Okay, so we run the numbers. The stock portfolio gets a Sharpe ratio of 0.026. That's its final score, its performance per unit of risk. Now let's see how the bonds did.
And here's the twist. The bond portfolio's Sharpe ratio is actually higher. It comes in at 0.035. So even though its headline return was way lower, it was actually the more efficient investment. It delivered more bang for your buck for the tiny amount of risk you had to take.
And this really gets us to the heart of the matter. The Sharpe ratio, it's not just some math formula. It's a whole new way of thinking about investing. It forces you to ask a much smarter question. Not just what was my return, but what was my return for the amount of risk I took. It's like judging a car not just on its top speed, but on its fuel efficiency. So I'll leave you with this question. If you're not looking at your investments on a risk-adjusted basis, what are you really measuring?
Welcome to The Explainer. You know, when it comes to judging an investment, we talk a lot about risk. But what if I told you that not all risk is created equal? Today, we're diving into a really powerful tool that helps you see that difference.
Okay, let's just jump right into this. We're always looking at an investment's return, right? But how do we accurately measure the risk we took to get that return? And maybe even more importantly, what kind of risk should we even be measuring in the first place?
And this brings us to a really crucial distinction between 2 famous performance metrics. And it all hinges on how they define risk.
Okay, so here's the fundamental difference. The super popular Sharpe ratio looks at total risk. It penalizes an investment for any and all volatility, period. But the Treynor ratio comes along and makes this fascinating argument. Why should we get penalized for risks that we can easily diversify away? So it focuses only on the risk that's tied to the entire market. You know, the kind you really can't escape.
So, to isolate just that market-specific risk, the Treynor ratio uses this really powerful concept. It comes from the Capital Asset Pricing Model, or CAPM. And that concept, its secret ingredient, is beta.
So that brings us to the very core of the Treynor ratio, beta. What exactly is this thing, and how does it actually measure this market risk we're talking about? Put simply, beta just tells us how much we can expect an investment to move relative to the market's own movements. It's really just a measure of its sensitivity to the market as a whole. Now, I know the formula might look a little bit intimidating at first. Beta is the covariance of the asset and the market divided by the variance of the market. But let's not get lost in the math here. In simple terms, covariance just measures how 2 things tend to move together, while variance measures how much something moves on its own.
Let's break that down even more. Think of it this way. Beta is simply a ratio. The top part of the fraction is asking, how much does my asset move with the market? And the bottom part asks, okay, but how much does the market tend to move on its own anyway? That's really it.
Okay, so we've got a formula, but what does the number it spits out actually tell us? That's what really matters here.
Well, if beta is exactly 1, that means the asset basically mirrors the market's movements. If it's greater than 1, like a lot of tech stocks, it's considered aggressive. It's going to move up more when the market's up, but yeah, it's also going to drop more when the market is down. And a beta of less than 1, that suggests a defensive asset, one that's less volatile than the overall market.
All right, now that we've got a solid handle on beta, we can finally put all the pieces together and see how the Treynor ratio actually works.
So how does it work? It's actually pretty simple. We take the portfolio's excess return, that's just the profit you made above what you'd get from a super safe investment, and we divide it by its beta. And the result tells you, for every single unit of market risk I decided to take on, how much extra return did I actually get for it?
Putting it into practice is actually really straightforward. You just need three things: your portfolio's average return, the current risk-free rate, and that all-important beta we just figured out. You plug those into the formula and boom, you're done.
And interpreting it is so simple. Just like with other performance metrics, a higher value is always better. It means you're getting a greater reward for each unit of market risk that you've accepted.
So, if the Treynor ratio offers this more specific, maybe more sophisticated view of risk for diversified portfolios, why isn't it as popular as the Sharpe ratio? Why do we hear about it all the time?
Well, it really just boils down to two things: complexity and consistency. See, calculating beta isn't exactly plug and play. It requires a statistical regression. And here's the really tricky part. Your beta can actually change depending on whether you use daily, weekly, or monthly data. The Sharpe ratio, while maybe less precise, is just simpler, and it gives you one consistent number, which is why so many people still prefer it.
So, what's the bottom line here? It's all about choosing the right tool for the job. You should use the Sharpe ratio when you're judging your entire portfolio's performance. But when you want to know if adding a single new stock is a smart move for your already diversified portfolio, well, that's when the Treynor ratio becomes your precision instrument.
And this choice between Sharpe and Treynor really gets to the heart of a key question in finance. Do you prefer a simple tool that gives you a broad but maybe flawed picture? Or do you go for a more complex, precise tool that tells you something very, very specific? The answer really reveals a lot about what kind of investor you truly are.
Welcome. Today, we're going to crack the case on how to really measure an investment success. We're going way beyond the headlines to figure out if a fund manager is actually skilled or if they just got lucky. And we're going to do it using a really powerful tool from the world of finance. All right, so let's jump right in. We're going to start with a riddle that pretty much every investor has to deal with. It seems super simple on the surface, but the truth is always a bit more complicated. Okay, check this out. Imagine a fund that returned 5.5%, while the market as a whole only returned 2.5%. So, the big question is this a good investment? I mean, at first glance, you're probably thinking, heck yeah, it is. I mean, look at the numbers. The fund more than doubled what the market did. Case closed, right? Well, not so fast. When it comes to investing, that big headline number, it's never the whole story. See, just beating the market doesn't tell you anything about the most critical factor of all, risk. Just think about it for a second. Did the fund manager get that 5.5% return because they were a genius, picking all the right stocks? Or did they just take on a huge hidden amount of risk that, just happened to pay off this time? If you want to be a smart investor, you've got to have a tool that can tell you the difference. And that brings us to the main tool in our detective kit. See, to figure out if a return is actually as good as it looks, we need a baseline. We need a way to calculate what the return should have been, given the amount of risk that was taken. So where do we get that baseline? Well, it comes from a really foundational idea in finance called the Capital Asset Pricing Model, or CAPE-M for short. This formula basically gives us the expected return for any investment. It does this by looking at the risk-free rate, what you could get from a super safe investment, and the investment's volatility compared to the market. We call that its beta. And this is where our investigation really gets interesting. Jensen's alpha is the name of our tool. And what it does is measure the gap, the difference between what a fund actually returned and what the CAPM formula said it should have returned. It's the performance that you just can't explain away by saying, oh, the market went up. Now, this formula might look kind of simple, but trust me, it's incredibly powerful. What it does is it strips away all the noise from the broader market's ups and downs. It lets us isolate the fund manager's real contribution. It's the thing that tells us, plain and simple, whether the manager actually added any value. And the best part? Figuring out what it means is super easy. If you get a positive alpha, it means the manager generated extra returns above and beyond what was expected for the risk. That's a sign of real skill. But if you get a negative alpha, well, that means they took on risk and didn't even get the return they should have. Not good. Okay, enough theory. Let's put this tool to work. We're going back to our first case, Fund A, to see what the numbers really have to say. Right, here's all the evidence we have on file from our source material. We've got the fund's actual return, the risk-free rate, the market's return, and the most important clue of all, Fund A's beta. Remember, that's our measure of its riskiness compared to the market. So with all our data points lined up, it's time to run the numbers. We're just going to plug these values right into our Jensen's alpha formula, and we can finally solve this mystery and find out the truth about Fund A. And the verdict is in! The alpha for Fund A is positive 0.069, or, to put it another way, a very impressive plus 6.9%. Wow, this is the power of alpha, right here. Our first impression, just looking at the raw return, totally wrong. It turns out Fund A wasn't just a good investment, it was an excellent one. That manager delivered way more return than you'd expect for the pretty low amount of risk they took. Now that is skill. Okay, so we've cracked the case on Fund A. Now let's bring in the rest of the lineup. We're going to run the same analysis for two other funds, Fund B and Fund C, and see how they compare. So when we run the numbers, a totally different story pops up. Both Fund B actually have a negative alpha. What does that mean? It means once you account for the risk they took, they failed. They didn't even deliver the returns they were supposed to. Basically, they underperformed. And hey, take a look at the market's alpha. It's 0. And that makes perfect sense, right? The market is our benchmark. It can't beat itself, and it can't lose to itself. It just is. It's the baseline that everything else is measured against. All right, let's pull everything together for the grand finale. Our source material actually gives us results for a couple of other performance measures too, so we can get the full picture and see who the real winner is. Okay, here's the complete scorecard. You can see our Jensen's alpha results right there. But we also have the Sharpe ratio. That looks at return versus all risk. And the Treynor ratio, which is a bit like Jensen's and looks at return versus just market risk. And check this out. When we rank all the funds based on these 3 different methods, the result is just undeniable. Fund A is number 1. Every single time. It doesn't matter how you slice it, Fund A is the clear champion here. And here's a really key insight, and this comes straight from the source material. The Jensen and the Treynor measures, they'll usually give you the same rankings. And why is that? Well, it's because they're both essentially asking the same question, just in a slightly different way. They're both focused on how a fund performs relative to its market risk, its beta. So from now on, when you see some flashy headline about a fund that beat the market, you'll know what the real question is, right? You'll ask, yeah, but what's its alpha? You've now got the tool to see past the hype and find out what's really going on. Thanks for tuning in.